Hello, everyone. Today we have with us Anil Bamboli, Senior Fund Manager at HDFC Mutual Fund. Welcome, Anil.
I want to.
Now, Anil, first of all, congratulations on winning the Morningstar Award in the short duration category for the fourth year in a row, and that's quite an achievement.
Thanks.
So, what has been your strategy to deliver such a consistent performance year after year?
Broadly, we've been following the same philosophy. We try and manage the duration with a medium-term view. We avoid short-term noises. We look at assets across the curve. So look at the yield curve, look at the spreads. Whatever is the most attractive is what we buy, and we try and sell what is the least attractive. And lastly, we take controlled credit risk. So if you see, predominantly the fund has always been maintaining more than 80% assets in AAA. And then the balance 20%, we have kept increasing or decreasing depending on the spreads that we see in the markets. So as a combination of this three things, I think we've been able to achieve the performance that we have.
And if we go back a bit, we saw a series of downgrades or defaults, especially post-IL&FS crisis. In such a scenario, what risk management strategies did you adopt to shield the fund from such exposures?
See, our credit philosophy boils around two main themes. One is SLR, which is safety, liquidity, and returns. So our portfolio creation gives a lot of emphasis on safety. Here, the key strategy is that we look at the 4 Cs, that is your character, capacity to pay, collateral, as well as your covenants. Characters plays a very big important role for us. I think following this 4C strategy, along with our controlled exposure, as I mentioned, we look at each credit and we rank it internally. The lower the score, lower the exposure. This model put together has helped us avoid most of the credit events that have happened.
The turbulent phase in the fixed income market over the last few years has brought to the forefront the risks that tag along with these investments. Do you think that this may further deter retail investors from investing in debt mutual funds? And in which ways the retail participation in debt funds is relatively low. So what, according to you, will be the impetus for them to choose debt funds over the safety of bank fixed deposits?
I think with the recent events, I feel that the investors are better informed. I think they look at the portfolios more closely before investing. I think one thing that they should keep in mind before investing is obviously the time horizon that they have and the duration of the product. And they're not looking at the past returns. I think these three factors put together, I think will help them decide which funds to invest in. I think comparing to FD is not really a correct picture. FD taxations are different. It is a straight, your fixed returns are there. Here, the returns over a period, I think, have done better than most of the traditional products that they would have invested. So I think they are not comparable. But I think with these events and looking at the risks, I think they will make more judicious investment decisions.
And given the interest rate, can go up from here once the economy is back on track, how should debt fund investors be positioned to take advantage of the rise in interest rates?
Our view has been that this volatility can happen in the next 12 months, and to take care of that, they should look at short to medium duration products. The curve is already very steep, so if they invest in short to duration product, they are capturing that steepness at the same time not taking undue duration risk. So as a combination of that, they will be safer investing in short to medium duration products. In short term, there can be some volatility. But over a medium term, as I said, over a year or so, I think their return should be competitive.
And what are some of the risks you are seeing in the fixed income markets right now?
Interest rate risk, I think that is the key risk. RBI will look to normalize liquidity going forward, maybe by end of the year. And we also need to see how growth pans out. This year, the growth will look very good. A large part of it would be because of base effect. So we need to see whether the growth continues in the next year. Average inflation would be much lower this year compared to last year, but it could still be more than 4%. So all these factors put together, we think that interest rate risk is there, and hence a short to medium duration product, which I was saying. On the credit side, I would say with the economy improving from last year, I think we are seeing improving credit environment. If you look at the credit ratios, which had fallen very sharply in the first half of calendar 20, and the second half and into this year also, the credit ratios have improved very sharply. So I think credit environment is improving slowly and gradually, but interest rate risk, I think, is something that is there. We don't think it's a very large or big risk, but yes, it is a risk that needs to be kept in.
Thank you, Anil, for sharing your candid views. I'm sure these will help investors immensely while making investment decisions. Also, thank you for taking the time out to be with
Thanks.
us today.
Thanks, Himanshu. Thanks, Morningstar.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.